Welcome back to the Noob Selling Options channel. It is absolutely fantastic to have you all here today. Look, get ready, because in this explainer, we're unpacking a really fascinating scenario that is unfolding in the market right this second. We're going to dive into why the market's absolute terror over AI spending has actually created a massive structural mispricing in the software sector, specifically targeting two absolute giants. We're going to put on our detective hats, look at the hard data, and prove exactly why these two assets are screaming buys right now. So you have to ask yourself, is the market just entirely wrong about AI spending? Well, here's the fundamental disconnect we need to talk about. Right now, the market is just aggressively punishing software stocks. And why? Because of this overwhelming AI capex anxiety. Investors are literally terrified about the sheer amount of money being poured into artificial intelligence infrastructure. But here's the reality, and it's a big one. We are actually shifting out from what's been a purely semiconductor-driven trade straight into a massive software utilization cycle. The market's looking in the rearview mirror, but the fundamentals, they're signaling a huge move forward. Okay, let's dive into this. Here is how we're going to break it all down today. 1. The market reality disconnect. 2. The forward peg framework. 3. MSFT's massive backlog anomaly. 4. Now's sub-1 peg anomaly. 5. 3 catalysts driving the re-rating. And finally, 6. A generational entry window. Starting things off with Section 1, the market reality disconnect. We really need to break down the perceived fear versus the actual operational reality that's playing out in enterprise tech. The market is basically acting as if these companies are just setting giant piles of cash on fire, burning capital on AI without any hope of getting a return. But honestly, the financial reality reveals a totally different story. We are actively transitioning to the software utilization phase. These companies are wide-moat compounders, and they are perfectly positioned to absorb the vast majority of enterprise tech spend as corporations finally start using the AI infrastructure they've just spent billions building.
Moving right along to Section 2, the forward peg framework.
To actually see this opportunity, we need the right lens to filter out all that lagging noise. The forward peg ratio is our primary tool here. It's calculated by taking the consensus forward PE and dividing it by the consensus forward long-term growth projection. You'll often hear that called G. By filtering our investment universe through these forward-looking valuations, we completely bypass all that short-term panic. Now, standard consensus filters assume a baseline benchmark of 1.0 as fair value. So if we can isolate mispriced structural assets trading close to or even below that 1.0 baseline, we found something incredibly special.
Which brings us to our first deep dive in Section 3, Microsoft and the massive backlog anomaly.
Everyone is hyperfixated on Microsoft's guided $190 billion AI infrastructure spend for 2026. Yeah, that compresses near-term free cash flow, but by obsessing over that spend, the market is completely sleeping on this staggering figure, $627 billion. That is Microsoft's commercial remaining performance obligations, basically their locked-in future revenue, and it surged 99% to hit this massive number. And here is the absolute kicker. Nearly a quarter of that massive backlog converts to recognized revenue over just the next 12 months. This is locked-in, highly visible growth.
Let's look a little closer at their core metrics. Microsoft's localized AI ecosystem has already hit a $37 billion annual revenue run rate. That's expanding at over 120% year over year. Meanwhile, its consensus forward PE has compressed down to roughly 22x. Just to put that into perspective, that's down about 35% from its historical 3-year average. When you align that against a highly secure 15% forward growth rate, its forward PEG sits at just 1.48. You are getting a structural, cloud-dominant hyperscaler at a deep discount, and it entirely de-risks the capital expenditure they need to scale up Azure's AI capabilities.
All right, let's pivot to Section 4, ServiceNow and the sub-1 peg anomaly. ServiceNow has faced some extreme multiple compression lately, pulling back over 50% from previous highs to trade under $90. But as we're going to see, this decline is entirely disconnected from its actual performance. Just look at this number, 0.95. That is an incredibly rare forward peg ratio for an asset of this caliber. We are talking about a company that displays structural, sticky gross retention rates above 98%. Let that sink in. Paying less than a 1x peg for a monopoly with retention metrics like that, it's an absolute historical anomaly. The fundamentals here heavily contradict the stock drop. Just look at their Q1 2026 metrics. ServiceNow printed 22.5% current RPO growth, hitting $12.64 billion. They maintained a massive non-GAAP free cash flow margin of 44%. And get this, large enterprise deals, we're talking transactions over $5 million, grew an astonishing 80% year over year. This kind of massive growth, which is projected at over 23% long-term, is exactly what drops its forward PE to roughly 22.2x and gives us that incredible 0.95 peg. Now, what's really interesting here is how perfectly these two assets complement each other. Notice how both Microsoft and ServiceNow have been compressed to the exact same valuation level, roughly 22.2x forward earnings. But they offer completely different profiles. Microsoft gives you a defensive mega-cap technology utility with a 1.48 peg. ServiceNow, on the other hand, gives you a high-velocity workflow monopoly at a 0.95 peg. Put them together and they form a highly reliable foundational pairing.
Let's move to Section 5, 3 catalysts driving the re-rating.
Let's see how this builds across 3 structural triggers that make right now the optimal time to look at this. First, the old seat count bear case dissolves. Second, the context layer defeats the commoditization of large language models. And third, the CFO ultimatum pivots corporate focus entirely over to ROI. Catalyst 1 is absolutely huge. The original short thesis argued that generative AI would shrink corporate headcounts, which would basically destroy per-seat SaaS licensing. That was the bear case, but it completely missed the transition happening right under everyone's noses. Both Microsoft and ServiceNow are successfully deploying consumption-based and agentic AI pricing models. So instead of just licensing a tool to a human worker, they're licensing autonomous digital agents that execute entire workflows. This shifts their addressable market from just employee software spend to targeting total corporate labor spend. It completely decouples their revenue growth from human headcount. Catalyst 2 is all about where the actual value gets captured. Raw, foundational large language models are facing intense competition and dramatic margin compression right now. They are basically becoming interchangeable utilities. The true, sticky enterprise margin belongs to the player who owns the system of record. Microsoft owns Windows, Office, GitHub, and Azure. ServiceNow acts as the core operating system across IT, HR, and customer service. And LLMs simply cannot act without context, and these two networks completely own the unassailable corporate enterprise context. And that leads us right into Catalyst 3. Software is the toll booth that monetizes the compute layer. I love that quote. Corporations simply cannot sustain massive exploratory infrastructure builds indefinitely. Chief financial officers are finally slamming their fists on the table. They're issuing a strict ultimatum. Give us off-the-box software applications that deliver instant, measurable ROI. This dynamic is pivoting corporate IT budgets straight out of raw compute and directly back to execution software layers like Microsoft and ServiceNow. Finally, Section 6, a generational entry window. So, bringing all of these analyzed data points together, the crucial point is this. When world-class enterprise monopolies with greater than 98% sticky retention rates compress down to roughly 22x forward earnings, you absolutely have to ignore the short-term macro noise. Accumulating these structural tailwind assets during this multiple compression cycle offers a highly attractive, fully de-risked entry. The data is crystal clear. Which leaves us with this final thought. Will you capitalize on this software utilization cycle or get left behind in the macro noise? The shift from experimental infrastructure to real application deployment isn't some future event. It's happening right now. If you found this explainer valuable and you want more data-driven deep dives just like this, please make sure to hit that like button and subscribe to the Noob Selling Options channel. We love having you in the community. Think deeply about this entry window, and I will see you all in the next explainer.